All right, let's dive into Apple's latest earnings report, their fiscal 2024 fourth quarter results. And I got to say, there's a lot to cover. So we're going to take a deep dive, use our earnings checklist, and figure out what these numbers actually tell us about Apple, how they're doing and what their future might look like. And to help us really break it all down, we have our financial expert here.
I'm glad to be here. I think what's really interesting about this report is that it goes beyond just the numbers themselves.
Yeah.
It gives us a glimpse into Apple's strategies, how they plan to stay on top in this crazy tech world.
Yeah, absolutely. It's a wild ride out there. So let's start with those headline numbers, shall we? Apple announced a record September quarter revenue, a whopping $94.9 billion. That's a 6% jump year over year. Pretty impressive, right?
Yeah, definitely a strong performance.
And their operating cash flow hit almost $27 billion, which means they returned over $29 billion to shareholders.
Those are some serious numbers, no doubt about it. But, the thing that really stood out to me was the record number of active Apple devices out there. We're talking iPhones, Macs, the whole shebang all over the world. That shows some serious customer loyalty, wouldn't you say?
Oh, absolutely. That's like they've built this incredible ecosystem that people just don't want to leave. All right, let's move on to the first section on our checklist, earnings power. It focuses on free cash flow as a key indicator. So can you break that down for us? What exactly is free cash flow and why should we care?
Well, think of free cash flow as the money Apple has left over after paying for its daily operations and any big investments it makes. You can think of it as the fuel that lets them innovate, create new products that people actually want to buy, and of course, return value back to you, the shareholder, through things like dividends. And get this, Apple generated over $118 billion in cash from operations in the last 12 months. That's serious financial muscle.
Wow, that's a lot of cash. It's no wonder they have the resources to constantly push the boundaries of what's possible in tech. But it's not just about the cash flow, is it? They also need to use that money wisely, which brings us to return on equity, right?
Exactly. Return on equity, or ROE, is all about efficiency. It tells us how well Apple is using the money invested by shareholders, basically you guys, to generate profit. And a consistently high ROE, above 15%, is usually a good sign.
So it's like a measure of how well Apple is turning your investment into actual profits, which is good to know. Now, let's talk about debt for a second. Our earnings checklist suggests keeping that debt-to-equity ratio under 0.5. Can you explain what that means in simple terms?
Sure. It basically means that for every dollar of equity, the money you and other shareholders have put into Apple, they should have no more than 50 cents in debt. This ratio gives us an idea of their financial leverage, how much debt they're using compared to their equity.
Okay, so if we look at Apple's balance sheet, it shows their total liabilities at $308.3030 billion. And their total shareholders' equity is $56.950 billion. If we divide those numbers, we get a debt-to-equity ratio of 5.4. That seems a lot higher than the 0.5 recommended, doesn't it?
Yeah, it does raise some questions. While a little bit of debt can be a good thing, to help fuel growth, too much can become a burden. It's something to keep in mind when you're looking at their overall financial picture.
You're right. It's all about balance. So let's move on to profit margins, another important part of our checklist. Why are both gross margin and operating margin important for understanding how profitable Apple really is?
Well, gross margin, it basically focuses on the profitability of Apple's main products, the iPhones, Macs, and all those services they offer. It shows us how efficient they are at managing the costs of actually producing those things. Operating margin, on the other hand, takes a wider view. It includes all of their operating expenses, things like marketing, R&D, even the uniforms for those Apple Store employees.
So having healthy margins in both areas is important for sustainable growth, right? And ultimately, for returning value to the shareholders, it's about getting the most profit out of every dollar of revenue, right?
Absolutely. Even a small improvement in those margins can make a big difference to the company's bottom line. And if we look at Apple's financials, their gross margin for the quarter was a solid 46%, and their operating margin came in at about 31%. Those are pretty impressive numbers, especially considering how competitive the tech industry is.
Yeah, those are some strong numbers. It seems like Apple is balancing innovation and profitability pretty well. Okay, let's move on to investor ratios, which includes things like the price to earnings, or PE ratio, and the price to book, or PB ratio. These can give us a better understanding of how the market is valuing Apple, right?
Exactly. They give you a sense of the market's sentiment towards Apple. Now, the PE ratio, it compares Apple's stock price to its earnings per share. A high PE ratio usually means investors are optimistic about future growth and are willing to pay a premium for the stock. They have high expectations.
So where does Apple's PE ratio stand right now, and what does that tell us about how investors are feeling?
Well, it's currently hovering around 27, which is higher than the average for the S&P 500. So it suggests that investors are pretty confident about Apple's future earnings growth. It's like they're betting on Apple continuing to innovate and dominate those markets they're in.
That makes sense. Investors are always looking for the next big thing, and Apple has a pretty good track record of delivering.
Yeah.
What about the price-to-book ratio? How does that fit into all of this?
So the PB ratio, it compares Apple's market price to its book value per share, which represents the net worth of the company's assets. A low PB ratio, usually below 1.5, might mean that a stock is trading close to or even below its book value.
So if a company's PB ratio is way lower than 1.5, it could be a sign that the market is undervaluing its assets, like finding a hidden gem in the stock market, huh?
You got it. But, and this is important, these ratios are just one piece of the puzzle. You always want to consider them alongside other financial metrics and qualitative factors, like the company's management team, its competition, and overall industry trends.
It's about taking a holistic approach, looking at the big picture, right? You can't just rely on one or two numbers. Okay, let's wrap up our checklist with growth and dividends. I see equity growth and dividends and share buybacks highlighted here. Why are these important, especially for those long-term investors listening in?
Well, equity growth shows a company's ability to increase the value of its shares over time. Consistent equity growth means that Apple is reinvesting its profits to grow in the future. And that's good news for you as a shareholder because it means your investment has the potential to grow in the long run.
It's not just about today's profits, it's about that long-term growth, right?
Yeah.
Now, what about dividends? Apple has a history of paying them to shareholders. What's the deal there?
Right. Dividends are those regular payments made to shareholders, usually a portion of the company's profits. It's a way for companies to share their success with investors. Our checklist recommends looking for companies with a dividend payout ratio, which is dividends as a percentage of earnings, under 60%. This makes sure the company keeps enough earnings to reinvest in future growth opportunities.
Makes sense. You don't want them paying out so much in dividends that they can't invest in their future. Now, what about share buybacks? How do those fit into the picture?
So share buybacks happen when a company repurchases its own shares from the market. It can be a strategic move to give value back to shareholders, especially if the company thinks its stock is undervalued. When done right, share buybacks can actually increase earnings per share and boost shareholder returns.
It's like the company's putting its money where its mouth is, showing investors that it believes in its own future growth. We've covered a lot today, from record revenues and cash flow to a deep dive into Apple's financial health using our earnings checklist.
Yeah, it's been quite a journey. We've explored everything from free cash flow and profit margins to investor ratios and dividend payout ratios. And I think we've gained some good insights into how Apple is navigating the world of technology and finance. It's a tricky balance.
Absolutely. And before we wrap up this part of our deep dive, I'd love to hear your final thoughts on Apple's overall financial health based on this earnings report.
Okay, well, big picture, Apple is in a strong financial position. They're generating impressive revenue and cash flow, their profit margins look good, and their active device base is steadily growing, which shows strong customer loyalty, and they're returning value to shareholders through those dividends and share buybacks. However, that debt-to-equity ratio is higher than our checklist recommends, so that's something to keep an eye on.
So it sounds like Apple is doing well, but there are a few areas that investors might want to watch closely. Before we move on, I want to leave our listeners with something to think about. Apple is a huge player in the tech industry, but things are always changing, right? What are your thoughts on Apple's ability to stay on top as new technologies emerge and competition gets tougher? It's a question worth pondering as we follow Apple's journey.
That's a great question. You know, Apple has this amazing track record of innovation, a devoted customer base, and a powerful brand. But the tech world is unpredictable. Things change fast. To stay ahead, Apple needs to keep anticipating and adapting to what consumers want. They need to invest in new technologies like AI and augmented reality and navigate that complex global landscape with smarts and foresight.
It's a big challenge, and only time will tell how Apple will rise to the occasion. But one thing's for sure, following Apple's journey is never boring. They always seem to be pushing the limits and finding new ways to surprise us.
And that's what makes analyzing these companies so fascinating. They're not just standing still, they're constantly innovating, adapting, and sometimes even disrupting entire industries. It's like watching a high-stakes chess match unfold in real time.
Exactly. That's why it's so important to go beyond the headlines and really dig into the financial details. It helps you understand what's shaping these companies and the tech industry as a whole.
You got it. It's about connecting the dots, seeing those patterns, and understanding why the numbers are what they are. It gives you the power to make smarter decisions, whether you're an investor, a tech enthusiast, or just curious about how the world works.
Well said. And on that note, we've come to the end of part one of our deep dive into Apple's latest earnings report. Thanks for joining us on this journey of financial discovery.
It's been my pleasure to share these insights with you. Remember, knowledge is power, especially when it comes to understanding finance.
Couldn't agree more. And until next time, keep exploring, keep learning, and keep asking those insightful questions.
It's going to be fascinating to watch how they use that cash, and their loyal customer base to keep ahead of everyone else in the coming years.
Oh yeah, for sure. Apple never fails to keep things interesting, always pushing those boundaries, finding ways to surprise us. It's pretty cool.
That's what makes analyzing these companies so exciting, right? They're not just sitting there, they're constantly changing, innovating, adapting, and sometimes completely shaking up entire industries. It's like watching, a high-stakes game unfold right in front of you.
Absolutely. And that's why it's so important to go beyond those headlines, dig deep into the financials. It helps you understand what's shaping these companies in the whole tech world.
Exactly. It's about connecting those dots, seeing the patterns, understanding the why behind the numbers, It gives you the knowledge to make more informed decisions. It doesn't matter if you're an investor, a tech enthusiast, or just someone who's curious about how the world works. It's all valuable.
Well said. And on that note, we've reached the end of our deep dive into Apple's latest earnings report. Thanks for joining us on this financial journey.
It's been great sharing these insights with you all. Remember, knowledge is power, especially when it comes to understanding the world of finance.
Couldn't agree more. Until next time, keep exploring, keep learning, and keep asking those thought-provoking questions. You never know what you'll discover.
It's going to be really interesting to see what they do.
Yeah, it'll be fascinating to watch. Well, that wraps up our deep dive into Apple's latest earnings report. It's been a great discussion. Thanks for joining us and exploring these financial insights.
Absolutely. It's been a pleasure sharing this with everyone.
And remember, knowledge is power, especially when it comes to the world of finance. Until next time, keep learning, keep exploring, and keep asking those insightful questions. You never know where they might lead you.